I know Duff and Phelps took over the cost of capital book. Was it 3 years ago now?
2014 was the first edition that we put out.
Well, time is crunching for me. And you took the book, and within a couple of years, you've converted it to a database computer program. Why don't you talk about why you did that and how that's working?
Okay, well, let me give you a little background. In September 2013, Morningstar announced that it was going to stop publishing various valuation books. It had decided that that was not consistent with their other businesses. So we at Duff & Phelps were a user of Morningstar data published in the Ibbotson Valuation edition yearbooks. And we had been publishing the risk premium report data, which I started developing in the early 2000s and had published actually on Roger Ibbotson's website for a number of years. So the question was, how were we going to respond? Not because we wanted to go into the book publishing business, but because our people use the data. So we were already a licensee of the Center for Research on Security Price Data in order to do the risk premium report. So we had a relationship there. Jim Harrington, who had been the editor of the Valuation edition and other Morningstar Ibbotson books, had joined me several years earlier, and we sat down and said, okay, how can we fill the gap for our own people and hopefully help others? So we decided, and this was not a long thought out process. I stuck my neck out and I told the powers to be at Duff & Phelps, we're going to publish a book. And the reason we chose to do that was not that we had planned a long time to publish a book. It simply was expedient. We got nothing from Morningstar. We weren't provided anything from Morningstar, including nothing about who had ever bought their book. So what we did was, because I had been co-author of the Cost of Capital 5th edition, we were able to borrow text from the Cost of Capital book. We were able to assemble text. We went to CRISP, licensed the data. We had a good relationship and continue to have a good relationship with CRISP. And we were able to put this together, and we viewed it initially as sort of a stopgap. That is, just to get over the fact that we had this short window from September 2013 until the data needed to be distributed in February of 2014. So we put together the book. Mm-hmm. We published that book, self-published the first year. For 3 years, Wiley published the book and distributed, and then we ended our relationship with Wiley and went back to self-publishing. During that year, when we self-published, we actually did what we probably would have done back in 2013, 2014, had we had more time, thinking about what is a new age way of delivering information. Right. And so you think about, when I started doing valuations, we did analysis on 14-column working paper, okay? Now you use Excel. So we wanted to take data out of the 14-column working paper environment and put it in the environment equivalent to giving you tools for Excel. So we decided, after a year of self-publishing the book, we decided that, for a number of reasons. First of all, we found it very difficult to deliver a book in a timely fashion, because to get a book published, all of the material has to be assembled before you go to press. If you're doing it online, you can publish the data, you can publish sections of the material as the material is available. So it takes a great burden off of us as deliverers of data, because the data is a timely product. That is, you want the data as soon as it's available. Most books, for example, the 5th edition of The Cost of Capital, we used examples from data that were 2 years earlier. So that wasn't going to work, the normal publishing, and it became a burden. So we decided, for a couple of reasons. First, it was easier for us. Secondly, we have an inventory of ideas of new data that we want to provide. And in a book form, there's just too much, there's too many pages then. And people get lost and they really don't take advantage of it. Third, we found people not using the data correctly. And how do I know that? Is I do litigation work, and we would review other people's products, other people's reports, and they were misusing the data. So we put together a guide of how to implement the data through going through the steps. It is not a black box. I use it in litigation. It can't be a black box. So every step is printable. Every step is auditable. All the data is there. We're going to be adding, it gives us the facility of being able to add both reference material, that's background material, as well as the potential of adding new data sets.
Well, it's truly a game changer what you're doing in the valuation space. So you go from the hardback books. What's next? What do you have on the agenda now?
Well, there's a couple of things. I hate to use the term artificial intelligence, but what we're going to do is improve the user experience. Now, for those of you like myself who have been doing this for a long time, you sort of know when you look at the raw data, whether you want to test something else. You have a sense of this. But to hand down this profession to the younger generation, we hire people who certainly don't have the level of experience we do. How do we sort of stand over them and point, have you considered this? Have you considered this? Have you considered this? In the process of delivering the data. So what we want to do is offer a more interactive experience with the user, so that the casual user, and that's the person who does 3 valuations a year, you don't remember necessarily all the nuances if you put down everything and you come back to it 6 months later. And clearly the young staff that you have working for you doesn't understand all the nuances. So since I taught the cost of capital seminars for a number of years, and in those seminars, we did this sort of interactive, how do you look at data? How do you look at alternatives? How do you test your data, etc.? We want to take from just a data delivery to being a teaching tool so that it can help with the casual user or the novice user. And let's take, for example, the corporate area as an example. Here we're dealing with people that are at least doing some valuations regularly. In the corporate world, they have to figure out the cost of capital. And one of the things that I've discovered about the corporate world is there is a lot of turnover. And so all of a sudden, someone gets shifted from one department to being in charge of coming up with the corporate cost of capital. All they know is what they may have learned 10 years earlier in their MBA class. How can I facilitate that person understanding the data, understanding how to match risk and return? I have to teach them and remind them the nuances. Everyone who had a class, some of us remembering years ago, it's like watching black and white television. Everything was simplified. We know the world is not simple. So how do you take the simplified world and teach them what they should be looking at and doing comparisons? Another thing we're going to be doing is integrating. We publish a data about industry cost of capital. So we've started integrating the industry cost of capital data with the base size premium, equity risk premium data, so that there's comparisons, so that people automatically get, well, look at what the industry cost of capital is for small companies in this industry. How does your calculation compare? And it's sort of helping sort of bridge. We have 4 books. We want to integrate those 4 books, or at least the US-centric books, the 2 of them, and the 2 international books, in a deliverable that's integrated so that people get the most out of the experience.
All right. Fantastic. In the meantime, until we get to that the next edition, the next version, for the practitioner that does do 3 a year, I know one of the comments we've gotten recently on our show from a couple people was, it used to be so simple, and now it's not. What should I do? You seem like the perfect person to ask that question to.
When I started in this business, and all I had was the Ibbotson data, I used the back page just like most people did, and for size premia, not knowing much. And then I was in a court case, and an academic who I respect very much challenged the whole concept of size premia, because the data was measuring size by market value. They said, how do you know that those companies with small market value are really small companies? Couldn't they be companies that are just in trouble? That is, a company whose debt has gotten so big that the equity has been bid down. So a colleague of mine at the time, Dave King, and I, we started investigating, was size based on fundamental measures, total assets, net income, sales, was the market recognizing that the difference in company size based on fundamentals gave you different returns. We started publishing the risk premium report data. We've been publishing that for more than 20 years now. It is designed for the small practitioner who doesn't know what the market value is, who knows when he goes that it's a small company, because it's obvious. You look at the balance sheet, you look at the income statement. So you can match the fundamental characteristics to the data in the risk premium reports, and we provide an extrapolation of the data for the companies so that you can use a regression analysis to extrapolate if in fact the company is smaller than this group of public companies, that you can feel comfortable that I'm getting a reasonable estimate of the rate of return for a small company. So these are tools that I started working on, as I said, 20 years ago, and improved since then, because I do small businesses too. The other thing that we provide in the resource section in the Navigator, Cost of Capital Navigator, is a display of the companies that make up our 25th portfolio, so that you can see, are there only big companies? Are there some small companies? And you can see what their profit margin is, etc., so that you can do the best job you can of what we are responsible for, and that's matching. Our whole job here is to match the characteristics of a subject company to the characteristics of the data from which you're drawing the risk premiums. And so we provide that underlying tie to what makes up that data. And now we do it for several of the portfolios. You know, we publish 25 portfolios, but people always ask, well, what about the 26th and 27th portfolio?
Sure.
That's the extrapolation through the regression. But if you look at the data about the 25th portfolio, you will find that there are many small companies in there, smaller than you think there are. We have this idea that public companies are all huge, and that's not the case. There are small public companies because we're pulling data off of NASDAQ, not just the New York Stock Exchange.
Fantastic. Well, thank you so much for being here this morning. We really appreciate it. Do you have any final thoughts or?
Yes, I very much appreciate the opportunity to be here and to be with you, and your inputs are very valuable to us at Duff Phelps in terms of being able to produce the product and the tools and in a way that is, we're all in this together,
Right.
okay? And that's really the philosophy that we try to do.
Again, thank you so much.